Okay, good evening, everyone. Can you guys hear me clearly, loud and clear? If any one of you can't hear me loud and clear, do type in the chat box and let me know, okay? So great to see all of you this evening. Okay. All right, so today is the last day of November and we are heading into the festive period right now with just one more month to go before we end off the year 2023. So I hope that everything has been going fine for you guys so far. Okay, so for those of you who are joining us for the first time tonight, let me just do a very quick introduction. I'm Hazel from the Joyful Investors, right? For those of you who are new, you may not be very familiar with some of the content, some of the things that we do at the Joyful Investors. So let me just very quickly share with you. We focus on sharing content, valuable content that empowers individuals who are on the journey towards FIRE, all right, financial independence and retire early. So what are some of the things that we share, right? From money mindset to stock market insights, investment strategies, right? So these are some of the things that we share. And through all this, we hope to equip our community with the knowledge and the tools that they need to make more informed decisions in the stock markets, right? So if you want to learn more from the content that we share, right, you can actually find us on YouTube channel where we do some video sharing on the essentials of investing, right? And we also cover certain investing concepts as well. We are also on Instagram as well as TikTok as well, where we post more bite-sized content, financial and investing contents, and tips that can smoothen your learning curve in this journey. Now, and if you want to receive more timely updates on the market happenings, right, you can also follow us on our Facebook page or our public Telegram channel, okay? Because we will share ongoing insights from on the latest market events. Alternatively, on Threads or as well as on Investing Note, okay, the investing platform, you will be able to see a more light-hearted side of us, all right, as we share about the stock market and the personal finance tips. Okay, so tonight we are back on our monthly Zoom webinar to share about the recent market update. All right, so do join us live if possible, if you're available for during the evening, so that you can receive more timely updates from us. Okay, before I begin, just a very quick disclaimer over here. Whatever we share tonight, okay, it is not a financial advice. Okay, this is just for my personal sharing, right? And it's more for educational purposes. So before you make any investment or trades, always do your own research and due diligence. Okay. So this is the overview, the agenda for tonight's sharing. Okay, tonight I'll be focusing mainly on the US market update. Right, in the previous sharing in the month of October, I have been touching more on Singapore REITs. Okay, so tonight we just switch gear back to the US stock markets. Right, so what I'll be sharing tonight would be firstly on I'll give you an update on the S&P 500 earnings season. Right, for the latest quarter 3 of 2023, for us to evaluate the fundamentals of the S&P 500. Now, following that, we will then move on to have a quick glance at the October's inflation data, as well as some of the insights that we can gather. Then finally, I will conclude this month's market update sharing by sharing with you a quick thought process as to how I usually identify investing opportunities in the stock market. And I also provide you with some stock examples. All right, so let's begin. Okay, let's start off with the earnings season for the S&P 500. So we are closing off the earnings seasons for the S&P 500. Now let us take a look at some of the numbers, right, and see how the S&P 500 has performed so far, right, overall in Q3 of 2023. Now the data that you see over here, okay, they are not the finalized set of data, okay, because I don't have the finalized set of data yet, but roughly this is the set of data where we have about more than 90% of the companies who have already reported their earnings. Okay, so roughly as the earnings season end, right, the number should be somewhere around there. We shouldn't be too far off from what you see on the screen over here. Okay, so how's the earnings report for S&P 500? Let's take a look. Now, among the S&P 500 companies which have reported their earnings, 82% of them have reported EPS above estimates, okay? And the question that you may be wondering is, so 82%, is that high or is that low? Okay, I don't know, right? So to assess these, what we can do is we can compare against the historical average for a rough gauge and for referencing, right? So if you compare this 82% against the 5-year average, it is actually above, okay? Because the 5-year average is 77%. Now, it is also above the 10-year average, which is 74%. So in essence, the recent quarter earnings have been pretty encouraging as compared to its historical averages. Now, if this 82% is the finalized percentage that we have for the third quarter, then this will also mark the highest percentage of S&P 500 companies reporting a positive EPS surprise since Q3 2021, which is 2021 is 2 years ago, okay? 2 years ago, we also had 82%, okay? So let me clear the drawings first. Okay, so that is for the percentage of companies reporting earnings surprise. Now, in terms of the magnitude of the earnings surprise, let's take a look. Now, companies are reporting earnings that are 7.1% above estimate. So this 7.1%, it is below the 5-year average of 8.5%, but it is still above the 10-year average of 6.6%. So I would say that it's actually not too bad, all right? Then, moving on, the year-on-year earnings growth rate, right, is for Q3 is expected to come in around 4.3%. Now, again, this is not the final earnings growth figure, okay? Because FactSet has not published the final figure yet, but this is based on about 94 to 95% of the companies that have already reported their earnings about 1 to 2 weeks ago, all right? So 4.3%. In fact, for those of you who have actually joined us before in the previous Zoom webinar session last month, you may have recall or have no slight impression that I shared that at that time, analysts estimate their initial estimate of this earnings growth was just a negative 0.4%. So right now it's a positive 4.3%, right? So meaning that overall the S&P 500 earnings, it has been doing notably better as compared to what the analysts had initially expected. And this quarter, Q3, it is likely, very likely, it will mark the first quarter of positive EPS growth since Q3 2022. All right. Now, so some of you might be wondering, where is this all this growth coming from? Okay, let's take a look. Now, the earnings growth for the quarter, okay, it has been mainly driven by this few sectors, okay, mainly the consumer discretionary. We also have the communication services. We also have financials as well as the technology sectors. So these are the sectors, if you take a look at this chart over here, these are the sectors that have actually reported the highest earnings growth rate among the 11 sectors that we have for the S&P 500. Now, for some of you who are not that familiar with all these S&P 500 sectors, and maybe you are wondering, okay, what are some companies under these sectors? Now, let me give you some examples. For instance, consumer discretionary, right? Some of the names that you may be more familiar would be, say, Amazon, okay, or Starbucks, Tesla, and so on. Then for financials, okay, it would be like the banks, like for instance, JP Morgan, we have Bank of America, and so on. Then communication services, we will have companies like Meta, which is the parent company for Facebook and Instagram. We also have Alphabet, which is the parent company for Google, okay, as well as Netflix. Then for technology, some of the companies that you may be familiar with will be Apple, Microsoft, Nvidia, and so on. Okay, so okay, let me clear the drawings first. Hold on. Okay. Now, so moving forward, it is forecasted that the S&P 500 would continue on the positive earnings growth trajectory. Okay, and we should have already passed the earnings recession for the S&P 500. Now, what is an earnings recession? Some of you might be wondering, what's an earnings recession? It is defined as the period where we have a decline on an annual basis, right? The corporate profits decline on an annual basis for at least 2 straight quarters. So if you take a look at the EPS, right, the earnings per share growth for the last 3 quarters, okay, it's a little bit small, but it's over here. It was actually a negative figure. So we actually experienced the earnings recession during the last 3 quarters, where we have earnings contraction for the S&P 500. But for the most recent Q3 of 2023, it's likely that it's going to be a positive number that we will see. All right. So overall, we have actually a rather positive set of earnings for this recent quarter for the S&P 500. Now, moving on, at the same time, we also received positive news from the inflation side. Okay. Now, headline inflation for October, it came in at 3.2%. Okay, which is down from the 3.7% that we had in the previous month in September. Likewise, for core inflation, which excludes the food and energy, it came in at 4%. So it declined slightly, 4%, from the previous month, which we had 4.1%. So overall, what we can see is that the general direction of inflation, right, is on a downward trajectory, okay, indicating a positive outcome from the rate hikes that were implemented by the Fed since over about 1.5 years ago. Now, generally, as I've shared with you guys before, generally the Fed focuses more on the core inflation because it leaves out the items that have more volatile prices like food and energy, right? So it is more useful for the Fed to use it to assess inflation trends. Now, and out of the various components that we had for the core CPI, a significant component is actually attributed to shelter. Okay, that means housing, where it makes up about 40% of the core CPI. Now, in fact, if we look at the inflation for the latest month, for October, inflation that excludes food, energy, okay, that means it's core CPI, as well as if we exclude shelter, we are actually just up by 2% year on year. Okay, so as I was looking through the past, whatever I've shared with you guys, right, on our community over the past market update webinars, about a year ago, okay, I was also talking on this topic of inflation, right? And more specifically, I was highlighting how housing prices were contributing to the elevated inflation at that time. Now, this is a slide that I shared back in October 2022. So that is about 1 year ago already. Okay. October 2022, this was one of the slides that I shared during the market update Zoom webinar. At that time, the housing prices, they were still rising. Okay. You can see from the red line, it was still rising, but there was a deceleration in the growth of the prices. Okay. Which is the black line. Okay. There was a deceleration. And if you could recall, the challenge that we faced at that time, the problem was that there was a time lag in the reflection of the actual housing prices in the CPI data. There is a time lag in the reflection of this actual housing prices in the CPI data. So consequently, the moderation in housing prices, they were not immediately evident in the CPI data back then. So during that period when many people, many investors, they were concerned about the high inflation, we shared with our community that things are actually not really as bad as it seems on the surface, okay? Because it will take some time for the deceleration in the housing prices to be reflected in the CPI data in the months to come. So it will take some time. Now 1 year have already passed since the sharing. And what we can observe right now for inflation is that things have actually played out, okay, where if you look at the CPI for shelter, okay, which is the blue color line over here, okay, the blue color line, the CPI shelter component, you can see that the year-on-year increase has peaked, all right, somewhat during the year, and right now it has been declining this year in 2023. So this have contributed significantly to the overall decline in the core inflation in the United States. Right. Of course, I'm not saying that inflation is right now already at a level where where the Fed is comfortable with. But so far, in the last 1.5 years or so, we have been making rather good progress, okay, where we see that right now, the overall trend for inflation is in a downward trajectory, okay? And we got to be patient as well, because remember that all this data, CPI data, economic data like CPI data, inflation rate, all these are lagging data. So firstly, it takes time for the efforts of the Fed to trickle down the economy. That's the first thing. Then secondly, it also takes time for the actual prices to be reflected on the CPI data. So it is a lagging data. We got to be patient, okay? Now, in terms of rate hikes, okay, which some of you might be thinking about, okay, so what is the probability of rate hikes? Now, in the upcoming December FOMC meeting, all right, if you look at this screenshot over here, this screenshot shows the probability of a rate hike in the upcoming 13 December FOMC meeting. Now, the percentage right now for the Fed fund rate to be remaining at 5.25 to 5.5%, right? The probability is a 97% probability, meaning that almost 100%, there's almost 100% chance of a rate pause in the upcoming December meeting. All right. And if we move forward to check out the probabilities for the future subsequent meetings, the next one will be in January next year, 2024. Okay, you can look at this date over here. Likewise, the probability of the rate remaining at the same level is about 87%. Okay, so it is also a very high percentage, 87%. And for rate hike wise, right, the probability is just about 13%. Now you can also look ahead to the next subsequent meeting that is in March 2024, which is even further down. In terms of the probability of a rate pause, right, is 68%. This number over here, 68%. And then the probability for a 25 basis point rate cut, it is about 21 to 22%, right? So effectively, right now, the debate has actually moved from how many rate hikes to how many rate cuts next year, okay? So right now, the focus is actually more on rate cuts right now. Now, but please note that all these probabilities that I share with you here, they are just a rough gauge, okay? And these probabilities numbers, they will fluctuate as and when there are any new developments in the market or in the economy, okay? And of course, the further away the meeting is, the greater the uncertainty of all these probabilities that you see over here, okay? They might fluctuate and move. So for those of you who are curious about what is this tool, right? If you want to check this out yourself, this is called the CME Fed Watch tool. Okay, over here, CME Fed Watch tool. What you have to do is just Google CME Fed Watch tool, and you should find it on the first Google search result, right? So you'll be able to access this tool on the CME Group website. Now, but having shared all this with you, having shared all the inflation data, please do note that macro environment or even rate hikes, they are usually not the deciding factor on the way that we invest in the stock market. Okay, that means to say, usually, I do not choose to invest in the stock market just because, inflation is easing, or just because the Fed may be embarking on rate hikes. Likewise, I don't stay out of the stock markets. I don't cut my equities exposure just because there are recessionary risk or just because there are inflationary risk. Now, why do I say so? The reason is because it is quite impossible for anyone to be able to consistently predict and make a very accurate prediction of the macro environment, be it in the next 6 months, next 1 year, or the next couple of years. It is very difficult for anyone to consistently make an accurate prediction. Now, let me just show you. For instance, if you look at the news headlines, you will notice that there will always be two camps. There will be supporters of both sides of an argument. Just like right now, we are having this situation where we are not sure whether the Fed is going to continue on rate hikes, or are they going to start embarking on rate cuts, right? So if you look at this screenshot over here, take a look. Half of them are telling you that rate hikes can't be taken off the table yet. And then there's another half saying that, okay, they think that the Fed is going to start cutting rates already. So no matter what argument, there will always be supporters of both sides. All right. So definitely, it is certain that one side will get their guesses right, and then the other side will get it wrong, right? But this does not imply that the macro environment is very easily predictable, right? Or those who got their guesses right, they are very accurate in making their predictions. No, we know that that's not the truth, right? So that's why Warren Buffett, one of the greatest investors in the world, he often shared about this. He shared that he don't use macro as a guidance for his investments that he make, right? So what did he say? He said that he don't use any of what the economists said as a guideline for his investments, right? And that if he had depended on the economic forecast, he don't think that he would be able to make any money. So while we can examine what policies the Fed is implementing, we can analyze the CPI data, we can consider the probabilities of rate hikes or rate cuts and so on. But these factors, they are typically not the most important factors that should influence our investing decisions in the stock market. Now, so what is the most important factor? Now, the most important factor still goes back to the fundamentals of the companies, the fundamentals of the businesses. Now, ask yourself, is the company that I want to invest in a quality business where their profits and revenue have been increasing and are likely to continue so? The second important question to ask yourself is, am I buying the stocks at a good price where the risk to reward is in my favor, or I'm buying with a margin of safety? Now, these are more critical considerations that will make you money in the stock market over the long term. Because eventually, as the stock market recovers, if you continue to own stocks of good companies, good businesses at a good price, it will allow you to participate in the upside in the stock market once the stock market recovers. And one of the primary reasons why this is so is because you must understand how the stock market works. The stock market moves in a cycle. Now, this is how the stock market cycle typically looks like. Okay, and this stock market cycle is influenced by the economic cycle, the corporate cycle, the corporate profit cycle, and we also have investor psychology cycle, and so on. There are also other cycles like credit cycles and so on. Now, let me elaborate further by drawing on our experiences in the past 2 years. So what did we see? What did we experience in the past 2 years? Now, during the high inflationary period, what happened was that we saw the central bank came in, right? The central bank came in, they intervened with rate hikes. So they started rate hikes. Okay, so we have higher interest rates. Now, what happens when we have higher interest rates? Now, the higher interest rates, it may hurt the corporate profits for the businesses. For some businesses, to a larger extent, like for instance, the REITs, because they depended heavily on borrowings, right? Then for some other businesses, to a smaller extent. And what happened was that investors, they became more risk averse. They became more risk averse, and what did they do? They switched to fixed income instruments. Because these fixed income instruments, they are able to pay a higher yield under the high interest rate environment. And so this resulted in a sell-off in the stock market. So this is what we have experienced, correct? Right, recently in the past 2 years. Now, but the question to ask yourself is, do you think this will continue forever? This is the question that we must ask ourselves. Do you think this is going to continue forever? The sell-off in the stock market will continue forever. The S&P 500 will go down forever. Now, not likely, right? At some point in time, once inflation stabilizes, what's going to happen is the Fed, right? The central bank will begin to cut the rates. Businesses will do better. Corporate profits will do better. The stock market would once again become more attractive again as compared to the fixed income instruments that can no longer give you a high yield. Because right now, interest rate is lower, they cannot give you a high yield anymore. And that's when the demand for stocks will drive up the stock market further. Right? So in other words, the weak macro environment, yes, it may impact the stock market in the short term. Okay, it may impact in the short term where we see the stock market crashing, right? But as long as we invest in good companies, sound businesses that have been doing well and are likely to continue to do well, and we also buy them at appropriate prices, or even take advantage of market crashes to buy them at very depressed and low prices, eventually, as the stock market recovers, we'll be able to profit from the upside. All right, because you must understand that the stock market moves in a cycle, right? It wouldn't always be at the downturn, right? Eventually, it's going to recover back up. The same goes for the economy cycle, the corporate profit cycle, as well as investor psychology, their risk appetite. All this move in a cycle. Now, if you want to learn more, you want to understand more in detail on how the stock market cycle works, you can actually check out a full video sharing, which I have already posted on our YouTube channel. Okay, so in this video, we'll share with you how the stock market cycle works, how investors can actually position their portfolio accordingly. So the full video is on our YouTube channel already. Okay, so right now, you may be wondering what are some opportunities in the stock market right now. So let's zoom in on the stock charts to find out more. So this is a stock chart for the S&P 500. Year to date for 2023, the S&P 500 has rallied up by about 18%, right, year to date. And what we saw was that recently, the S&P 500 actually rebounded off this point, right? Somewhere around the $410, $411 region, okay? Which, as I've shared with you guys in the previous webinar, this is actually one of the possible immediate supports, right? If you use the Fibonacci retracement tool. So right now it has already rebounded off that level, okay, and we're somewhere around here. Now, to put in some context, right, this recent retracement that we saw, it is only considered a market correction. It is not a crash, okay? It is not a market crash. This is not a crash. That means this part. Okay, let me draw again. Okay. That means this recent retracement, this part over here that I circled, it is just considered a market correction, okay, of about 10 over percent. Now, market corrections of such magnitude, they are pretty common, okay? On average, they happen about once a year, okay? So it is pretty common to experience market corrections in the stock market. So if we use the S&P 500 as a rough gauge for the overall performance of the U.S. stock market, if you had invested back then around here, right, where we had a market crash, right, you will be sitting on some very good gains right now at the moment as the market recovers into a bull market. Okay. Now, in fact, for most of the gains that we saw in 2023, they have been contributed by the Magnificent Seven. Now, who are the Magnificent Seven? The Magnificent Seven are, we have Apple, Alphabet, Amazon, right? We have Microsoft, Meta, Tesla, as well as NVIDIA. So this Magnificent Seven. Now, this Magnificent Seven, they make up about 29% of the market cap collectively. And the returns, if you look at this chart over here on the right, the returns is about 71% year to date. For the Magnificent Seven alone, okay, it's about 71%. Whereas if you look at the gains for the remaining 493 companies, is about 6% over here, okay, 6%. Can you see the huge difference, the huge contrast in their stock performance? Then for S&P 500, of course, it's in the middle, okay, about 18-19%. Now, this Magnificent Seven, okay, these are the sectors that they are in. Okay, Microsoft, NVIDIA, Apple, they're in technology. And then Amazon, Tesla, they're in consumer discretionary. Then Meta and Alphabet, they're in the communication services sectors, which are also that three sectors that we talked about earlier on, isn't it? Right, if you remember just now, at the beginning of the webinar, I was sharing with you some of the sectors that have contributed to the earnings growth for the recent quarter. And these were the top three sectors that were mentioned as well. And overall, for the entire year 2023, these are also the sectors that have been performing well in terms of their earnings reports. Okay. In terms of the stock performance, okay, it is also this top three sectors. Okay, the one in blue is discretionary. Then the one in green is communication services. The one in purple is technology. So in terms of stock market performance, these are also the top 3 sectors for S&P 500, where they have garnered double-digit returns, right, year to date in 2023. So for investors who have missed the opportunity, you didn't get to buy during the market crash, the likely question that they may be thinking on their minds right now is, so should we now then chase after the prices to invest in these top 3 sectors, or to invest in the Magnificent 7, since they are the top performing for this year? Now, if you have been following our sharing for some time, you will know, I think you should be familiar with our investing style by now, and you will know that my answer to you will be a no, right? For us, we never chase after the prices. So instead of chasing after the prices, we prefer to look at those stocks or sectors that are still currently beaten down, but they have a very good potential to actually recover from their bottom, so that the risk to reward is more in favor when we purchase the stocks, right? We don't like to chase after the stock prices. Instead, we will look at currently what are the stocks or sectors that are still beaten down, but they have a very good potential to actually recover and rally back up. So remember, this is a 2-part thing. That means the first one is I want to find those stocks or sectors that are beaten down, currently beaten down, and they must have sound fundamentals so that they have the potential to recover from their bottom. If you invest in something that is beaten down, but it does not have sound fundamentals, then there is no potential for it to recover. So this is to make sure that the risk to reward that you undertake is in your favor. That means the potential reward that you can make is greater than the risk that you undertake, because they have sound fundamentals. Okay? So if you look at this chart over here, a lot of investors, what they will do is they will continue to chase after this segment, these 3 sectors. But for us, we don't like to do that. Instead, we will try to look out for opportunities in those that are still beaten down. So this is our investing style. So for instance, some of the sectors that we are more keen to invest in would be, for instance, the staples, right? The healthcare, or even financials, right? So this is just an example, okay? As usual, this is not a financial recommendation, so please do your own due diligence. Now, moving on, I'm also going to share with you some stock examples. Okay, let me clear the drawings. Okay, hold on. Okay, now let me also share with you some stock examples, but please, this is not a financial advice or financial recommendation. Now, the first stock example that I want to share with you tonight is called Bank of America. Okay, the stock ticker is BAC. So Bank of America is a fundamentally sound stock. Now, if you take a look at the stock chart over here, in 2022, you can see this is the part where we had the 2022 market crash. Okay, which is what most other stocks or other sectors experienced. Majority of them had this 2022 market crash. So it was actually down by about 40%. Okay. Now, but something that is slightly different. Okay, the situation was slightly different because for the banking sector, if you could still recall, sometime in March this year, we had the regional banking crisis. So the banks actually saw another sell-off over here. So for Bank of America, for their case, they actually saw a decline of more than 25%, about 28% or so. Okay. Now, so for banks, we must understand that banks, they are more cyclical in nature. So what does that mean? More cyclical in nature, meaning to say that if you look at their stock charts, they will go through bigger rallies. They will also go through bigger declines. You can see over here, this is a stock chart that shows you where I zoom out over the last 20 to 30 years. This is year 1997. You can see bigger rallies and bigger declines. Especially during certain crises, crashes, right? Recession, you might see that they have bigger declines as well. This is unlike other sectors, like if you say tech sector, or if you talk about, say, consumer staple sector, okay, which if you look at their stock chart, they generally have a nicer uptrend, even though in between they will also have retracements as well, crashes as well, but their stock chart don't look like this, okay, not as cyclical. So if we look at the weekly view, now this is a zoom out stock chart of Bank of America. This is on the weekly view. Okay, you can see over here, this is 1 week. Okay, so weekly view. On the weekly charts of Bank of America, what we can see that is that during major crashes for this stock, they actually found some support over on this long-term trend line. Can you see this black color diagonal line? Okay, that is upward sloping. This is the long-term trend line. You can see that during bigger crashes, okay, where it crashed down, then this part where it crashed down, they tend to find support at the long-term trend line. So this trend line over here is acting as like a support, okay, but a diagonal one. So usually what we like to do is we like to buy the stock when the prices hit a support, when they go to near the support, because the probability of a rebound is generally higher. So the risk to reward is more in our favor. So as you can see over here, this is where we are currently, the last circle over here. Recently, the stock prices have actually retraced back to the trend line, okay, which is acting as a support. So that is actually a good buying opportunity if we are looking to invest in Bank of America today. Okay, so this is sharing for Bank of America in terms of their stock chart. So I'm skipping the part on fundamentals, okay? I'm just zooming in on the stock charts. Okay, for those of you who are more interested in, let's say, the broad sector, that means I don't want to invest in individual company. I want to invest in the ETF, the broad sector, like the financial sector, right? The ETF that you can look at will be XLF ETF, okay? And as you can see over here, this is how the stock chart look like. So again, in 2022, we had the market crash where it found its bottom at somewhere around October 2022. Then after which, initially the prices were recovering. They were initially staging a rebound after the market bottom in October 2022. Where you see higher highs, right? Higher highs. So you can see it is moving higher, right? Higher highs. And the lows are also going up. Okay, higher lows as well. So you have, initially you have an uptrend. But the problem was for their situation was a bit special because we had the regional banking crisis, right? In March, early March this year. So that's why the uptrend actually failed. Okay, because of the regional banking crisis that broke out and they actually came crashing back down again. So this is how the stock chart look like for the XLF ETF. Now, so in terms of the TA, technical analysis for XLF ETF, okay, you can see that there is some horizontal support around this price region. Okay, right now it has already rebounded off. It has really rebounded off the horizontal support, right? But if let's say I'm looking to invest in the XLF ETF, then what I'll be looking at is when it retraces back to test this horizontal support again, that would be a good buying opportunity where the risk to reward is more in our favor. Okay. Okay, let me just share one last one. Coca-Cola, okay, which is for the sector of consumer staples, right, or consumer defensive sector. Now, for Coca-Cola, no matter whether the economy is in a recession or whether we have high inflation, consumers continue to drink soft drinks, right? Which is why it is considered as a defensive stock, okay? So it is like a necessity for people. So some of you guys here may also be able to resonate with this personally, where even though we have high inflation, right, but you continue to drink soft drinks, okay, because it's like a necessity for consumers. So if you look at the stock chart, in terms of the stock chart analysis, you can see horizontal support somewhere around this region. Again, recently it has actually tested over here, but it has already rebounded off already. So if let's say I didn't manage to buy Coca-Cola at this point in time, and right now it has already rebounded off, what I will do is I'm not going to chase after the prices, but instead I'll only buy again when it retraces back down to test this horizontal support level again. Okay, so this is how we actually apply technical analysis to help us buy the companies, the fundamentally sound companies at better prices where the risk to reward is more in our favor. So in essence, this is actually a risk management strategy where we don't want to chase after prices. We are not willing to buy even if it's a good stock, but we are not willing to buy at overly high prices, right? Okay, let me just go one step further, okay, where if I zoom out for the Coca-Cola, we are still at Coca-Cola. If you zoom out to weekly charts, earlier on it was daily charts. If I zoom out in time to look at more years, right, you can also see that there is this long-term trend line, okay, long-term upward sloping trend line, which is acting as a support over here. So you can see this is acting as a support, right, support, support. Okay, every time when it tests this trend line, it will rebound back up, okay? Then this is during the COVID crash period. Of course, it did went below, but eventually, right, it also hovered around this region for some time before it went back up. So on the weekly charts, we can also see this trend line. Now, this trend line, of course, it is even lower possible support level. So when would this kind of lower support level be tested? It will be when there is any sudden black swan event, right, or any sudden crisis. It could be a sector specific crisis, it could be a company specific crisis, okay, where you have a sudden crisis. It is possible that prices can still suddenly plunge and revisit all these lower support levels again, okay. Please don't get me wrong, I'm not saying that Coca-Cola is going to crash to this level. That's not what I'm saying, okay. I'm not saying that Coca-Cola is going to crash to the trend line. What I'm saying is that moving forward, if there is any sudden black swan event or any sudden crisis for the company, then this is another level that we will look at moving forward. So I'm just going one step further to share with you some additional insights that I can get from analyzing the stock chart for Coca-Cola. Okay, but as usual, always remember that TA, technical analysis, is not 100% fail-proof, right? So there are times where let's say you buy at a support level, but you see that the share price may still break through the support level, especially when there is certain crisis, right? So, but overall, why we use TA is so that it can help us to identify more appropriate prices to invest in and to buy. Because just like any other methodology or strategy in the stock market, there is no one perfect methodology or strategy that works 100% all the time. All right. Okay, before I end off, right, let me just very quickly touch on the Santa Claus rally, because we are already in end November. Next month is December already. Now, so as we approach year end, a topic that is always being talked about is Santa Claus rally, right? Investors, they are anticipating whether there will be a Santa Claus rally this year. Now, for those of you who are hearing this for the first time, right? What is a Santa Claus rally? It is a tendency for the stock market to increase during the last 5 days of December and the first 2 days of January. Okay, so how likely would this happen? Now, if you take a look at some historical statistics, this is a tracking of the past periods where we saw some years, right, where we had the Santa Claus rally, and then some years we are in the red. Now, overall, you can see that most of the time we're actually in the green, okay, during that period for Santa Claus rally. So about 78% of the time, right, Santa Claus rally has occurred about 78% of the time over the past 20 years. So this is actually just a seasonal pattern, right, that December is generally a more bullish month. Now, will this year be the same? Maybe, or maybe not. I'm not sure, right? It could be if we see that the yields continue to fall, right? The yields continue to fall, which is generally a more positive sign for the equities in the near term, okay, in the near term. But if there's any sudden turn of events, right, the market can still move in any way that it wants, right, in the short term. So just continue to invest in the quality companies, in the quality businesses, and you buy them at good prices, then over time, you should actually do fine in the stock market. All right. So this concludes the market update for the month of November. Next month for December, I will be taking a break from this market update sharing. Instead, I will do the sharing in early January. Okay, so early January on 13 Jan 2024, right, which is a Saturday afternoon, I will be doing a 2024 stock market outlook. And in this market outlook, what we will be doing is we will be sharing with you the financial landscape for Singapore, for US, for China as well, right? As well as some of the market opportunities that we are focusing on in the upcoming 2024 year, right? So this event is an in-person event, right? So it is not over Zoom webinar, right? And the event will be held at Raffles City Tower. So this is a complimentary event, right? So if you want to secure your seats, right, just scan this QR code at the bottom left over here, and you'll be able to sign up via Eventbrite. Okay, so do secure your complimentary tickets early. All right, and book this date in your calendar, and hope to be able to see you guys in person at the Market Outlook event. Now, on top of this, we also have other upcoming workshops lined up for you in the year 2024. Okay, this year we have completed all the workshops already, right? The next upcoming ones will be in the new year 2024. So if you are interested to learn more on how to analyze the stock charts, right, apply technical analysis, we have a session dedicated to share with you, right, to teach you on how to do so. So in the session itself, we will be sharing with you some of the useful technical indicators, right, as well as why do these technical indicators even work, right, over time. So this is to help you to be able to buy and sell at more appropriate price level instead of just randomly buying and selling as and when you feel like it. All right. Then on top of this, there is also another workshop on REITs, right? So if you are interested to learn more about how to build up your own portfolio of Singapore REITs to earn some passive income, right? The next upcoming workshop will be in March. It's on a Sunday. Okay, usually the workshops are on weekends, right? Weekend afternoon. So if you want to sign up, you can actually scan the QR code over here at the bottom left. So in the workshop itself, we will be sharing with you how to cherry pick the Singapore REITs to invest in. We'll also be sharing with you something that many people tend to ignore, which is how do I buy Singapore REITs at more reasonable prices. So we'll share with you how to look at stock charts. All right. So if you're keen, you can just scan this QR code over here and you'll be able to secure your tickets via Eventbrite. All right, so that's the end of tonight's market update sharing. If you find our Zoom sharing useful, do join us for future sessions. And I also hope to be able to see you at the Market Outlook event in January, right, in person. So if you want to be notified of our future sessions, right, what you can do is just join our public Telegram channel, right, where we will usually do the posting of our upcoming Zoom webinars, right? So have a good night, and I hope to be able to see you in person at the Market Outlook 2024. Thank you.